the group account is also a part of the compulsory question. The published, which it can be either the cash flow or the normal published account. So let's introduce this group. We summarize. We are not going to write a lot of literature because we know group is when you're consolidating account for more than one company, that we call it group. So what we are just going to see is the adjustment. What are these adjustments which we are required to have when handling the group account? So we write the adjustments and then see how to approach the question. At least you need to get them like 8 months, not necessarily to get everything, but at least to know how to put some 3 marks in the group. So let's see the, what do we call, the specialized transactions. The specialized transaction. So let's have the specialized transaction. Specialized transaction. So this specialized transaction number one is intercompany balances or intergroup balance. Intergroup balance. Intergroup balance. So when you say intergroup balance, you find that A and B owe each other. So we call it intergroup balance. So you write to say this refers to the intercompany indebtedness. This refers to the company indebtedness, or we can just use the best one, owing. Refers to the companies owing. Refers to the companies owing. Yeah, that is in case where the company group owe each other. So that is the simpler word to use. Now, how do we recognize this intercompany owings? How do we recognize these intercompany owings? So the intercompany owings, you debit so we debit and credit. So we have to remove it from another company and also add it in another company. So what do? We debit which and credit which? Receivable. Remember, owing, we are talking of receivable and payable. Receivable and payable. So we debit the payable to remove because we are removing. We debit the payable. And then we credit receivable. We credit receivable because these are, receivable is asset and this is a liability. So if you debit a liability, it means you are reducing that value of liability. The same with assets. So that's what you need to know for intercompany balances. Number two is intergroup sales and unrealized profit on closing stock. Intergroup sales and unrealized profit on closing stock or the inventory. Unrealized profit on the closing inventory. that you say intercompany sales occur where group company sells goods to each other at a profit. Say intercompany sales occurs where the group companies sells goods to each other at a profit. It's happened where the group company sells goods to each other at a profit. So what are the treatments of these intergroup sales and unrealized profit? The group sales and unrealized profit. So if there is that, what do we do with the sales? Because we also need to eliminate this one. Remember, there is no actual profit here. It is the same company transaction, doing the transaction. So there is no profit because profit should come from a third-party company. So then we have to eliminate this. So put another point and say intercompany sales are eliminated. Intercompany sales are eliminated in full from both sales. Intercompany sales are eliminated in full, from both sales and cost of sales. From both sales and cost of sales. From both sales and cost of sales. So we eliminate all from the sales and the cost of sales. Now, when we say we eliminate in full from sales and cost of sales, where do we credit? Where do we debit? Where do we credit? Where do we debit? If you are reducing sales, do we credit or debit? Sales is an income, and the income should have a credit balance. Now, when we are reducing, we have to debit to reduce that. So we debit sales, we credit cost of sales. We credit cost of sales. And then remember, there is part of unrealized profit here because this sales, it is not for the third party. So there is an element of profit not realized. So we also need to adjust that. So before we do adjustment, write that unrealized profit. Unrealized profit. And then to say, occurs where the intergroup sales of the inventory remain in the stocks. Occurs where intergroup sales of inventory, intergroup sales of inventory remains in stock. Remain in in stock. Remain in stock. Remain in stock. Now let's see how to adjust it. Debit the cost of sales. Debit the cost of sales. Debit cost of sales. That is plus, you add the cost of sales, and then you credit the inventory because we are dealing with the inventory. So we remove it in the inventory. So we credit inventory. We credit the inventory. We subtract in the inventory. So that is unrealized profit. Unrealized profit because we will apply some profit margin ratio. We'll apply some profit margin ratio. So let's see another adjustment, which is number 3, intergroup sales over fixed asset. Intergroup, that is number 3. Intergroup sales. Intergroup sales of fixed asset. Intergroup sales of fixed assets. Intergroup sales over fixed asset. So for the intergroup sales of fixed assets, intergroup sales of fixed assets, say this is the sales of a fixed asset by one group company to another. This is a sale. This is a sale of fixed asset by one group company, to another. With a full stop to another. Then you say, in case of this transaction, these two adjustments need to be made. So, in case of this transaction, then there is adjustments to be made, which we have to eliminate the profit recognized in this one, because whenever you do a sales, there is a profit margin which you have to make. So we have to eliminate that profit first. So we do the first adjustment under this, we call it A. The first adjustment is A, that is eliminating any profit recognized. Eliminating any profit recognized. Eliminating any profit recognized. How? By debiting the cost of sales, that is the P&L, by debiting the cost of sales, that is P&L, profit and loss account, and credit the PPE account, the property, plant, and equipment, and credit the PPE account. Good. Then now, adjusting for overcharge depreciation. There will be an overcharge depreciation also in this case, because you're selling it to a different company, the other company also they have to do their own depreciation. You have already calculated depreciation, and it is the same company. So there will be double accounting of depreciation. So that is B. B is adjusting for overcharge depreciation. Adjusting for overcharged depreciation. Adjusting for overcharge depreciation. So what do we do for that? We debit the PPE account because they have been reduced. So it may reduce the assets. So we debit the PP account, we credit the cost of sales, the cost of sales. We credit the cost of sales. We credit the cost of sales. So that is the intercompany sales of a fixed asset. So we'll see how to calculate this one using some formulas. Now let's see another one, dividend from the subsidiary. Number 4. Number 4 is dividends. Dividend from subsidiary. Dividend from subsidiary. Dividend from subsidiary. So dividend from subsidiary, you say dividend are distribution of profit to the shareholders. Dividend are distribution of profit from to the shareholders. So that we all know that dividend is a distribution of profit to the shareholders. But our main concern is how to do adjustment here. So we can say dividend may be paid out of pre-acquisition. Dividend may be paid out of pre-acquisition. That is before you acquire this subsidiary company. Dividend may be paid out of pre-acquisition or before you acquire this company, or paid out of post-acquisition or after you have acquired, or paid out of post-acquisition, or paid out of post-acquisition. That is after you are paid. So the parent share of pre-acquisition dividend is credited to the cost of the investment. So let's see the journal. Let's see the journal of dividend from a subsidiary. So we debit, we credit the cost of investment, we remove it from the cost of investment, and then we debit the cash, bank, or dividend receivable. You either debit the cash because you are receiving money, bank, or dividend receivable. Or dividend receivable. That is for pre-acquisition dividend. So this is pre-acquisition dividend. This is pre-acquisition dividend. Pre-acquisition dividend. That is pre-acquisition dividend. What about the post-acquisition dividend? That was A. B is post-acquisition dividend. If you receive dividend after acquiring this company, what will be the journal? We debit the cash because we are receiving. And then you credit the investment income. You credit the investment income. You credit the investment income. The other one, remember that dividend, if you pay dividend, if you get a dividend before acquisition, then that one, it is part of the purchase consideration. So they have been credited in the purchase consideration. That's why we are crediting the cost of investment instead of an income account. But this one now, after you acquire, that company now belongs to you. So if you get any dividend, then it goes to the investment account. So what else do we remaining with? So those are the basic the basic adjustment which you will not use in the exam. You will not miss this one. So let's see a format of a group income statement. A format of a group income statement. So let's have a format of group income statement. You will not miss a group question, but it is not a must get everything. There's a lot of free marks. So this is what we want, these free marks, because that one is the one which will give you pass. So we start with the sales. We start with the sales. So we take for the parent, I will use P to represent for the parent plus the subsidiary. So we take the sales from the parent plus the sales from subsidiary. We divide the subsidiary. Subsidiary is a company owned by the parent company with only more than 50% of the shares. Then we call it a subsidiary. Minus the intergroup sales. Minus the intergroup sales. Minus the intergroup sales. So that we get our sales value there. So you find that always you will get this. Always you will get the sales from for the parent and subsidiary. So in any case, you don't need to miss these marks, 1 mark here. Because no calculation here, everything you will be given. So don't miss that 1 mark. And then less the cost of sale. Cost of sales. So also cost of sales, we take for the parent plus the subsidiary minus, we have said, whatever you subtract for the intercompany sales, it will affect both sales and cost of sales. So whatever you subtract here, you subtract the same value here. So we have the intergroup sales plus the unrealized profit, the URL or URP there, plus unrealized profit. What I'm doing here is these journals that you have written here. Where you see, eliminating any profit from recognized. We say it, we debit the cost of sale, that is the profit and loss. So if I add here, I'm removing it. If I add here, I'm removing it, that unrealized profit. What about the overcharge? What about the overcharge depreciation? We have been told the overcharge depreciation. If you check our journals, overcharge depreciation, you debit the cost of sales. So which means you subtract here. So we have the overcharge depreciation. Overcharge depreciation. We find to the overcharge. You can call it the overcharge depreciation. Overcharge depreciation. And then you get the value there. So that is for the cost of sales. The cost of sales. And in most cases, you will find for unrealized profit and either the overcharge or undercharge depreciation. If it is undercharge, then you add. Then, so that one will give us gross. If you take this, subtract, you will get the gross profit. We get the gross profit. Then we say add other incomes. Add other incomes. So these other incomes, we might have the investment income. We might have the investment income. dividends, dividends, but dividends, you have seen the adjustment of the dividend. Now, then we less expenses, less expenses. Now, for expenses, also, this is where you get your free marks. You have seen around this will be free. This one, so already we have 3 free marks. Expenses, also this one should be a free marks. We have the administrative expense, which you take the parent plus the subsidiary. You take the parent plus subsidiary. Parent plus subsidiary, that one also should be free. Distribution, parent plus the subsidiary. Finance cost, parent plus the subsidiary. Parent plus subsidiary. And then in case there is any impairment of goodwill, less the impairment of goodwill. If there is any impairment of goodwill, subtract. So this, if I take this, whatever I'll get here as a total income, subtract this, you will get the profit before tax. So we get profit before tax, and then to less tax expense. Take the parent plus the subsidiary. Take the parent plus the subsidiary. Then you get the profit. This will be profit after tax. Profit after tax. And then from there, we add profit from share of associate. So you will take any associate. When you say associate, is a group account, but it's not a group member, which the parent company own anything which is less than 50%. Anything less than 50%. You also have the joint venture. You also have the profit from joint venture. Profit from joint venture. Profit from joint venture. So joint venture also is a group account, but not a member. That's why we are not consolidating all the entire transaction of the joint venture. So joint venture, when the parent company own exactly 50%, then we call it a joint venture. So from there, we get now the total profit. This will be the total profit after tax. Now we distribute now to the non-controlling interest and the parent company. So we will have, after this, we will distribute to get profit attributable. So this is the total profit. This is the total profit. And then from there, we will get profit attributable. Profit attributable to NCI. Profit attributable to NCI and profit attributable to parent. Profit attributable to NCI and profit attributable to parent. So when we talk of NCI, this is the share which the parent company is not controlling. That is NCI, which if you cannot, like, if you acquire a company, you control 80%, 20% is what we refer as non-controlling interest. Non-controlling interest. So this is the format which you need to have if it happens that you get a question of an income statement. The last thing walitest ilikuwa which approach of the balance of the group account. Was it the balance sheet approach? Or we have not seen. Was it the balance sheet approach or it was the income statement approach? Let's see. Yeah, it was the balance sheet. It was the balance sheet approach. Either way, either balance sheet approach or the income statement approach, you have to get some marks. Huh? You have to get some marks. So let's find out for an illustration. So you can tap this one. December 2023, GL&D Limited. December 2023. It has the consolidated statement of profit and loss and the consolidated financial position and the consolidated. They have the two, but you will find that also in exam you can get one question only for the profit or the balance sheet So, but we say it for group. Don't ever try to say that you will balance the group account. Try as much as possible to get some free marks. Try as much as possible to get the free marks. So December 2023. December 2023. Question 2. December 2023, question 2. December 2023, question 2.